Welcome everybody, and I just noticed I got the wrong date on my slide, so let me change that real quick. That's funny. I do this all the time. I try and get this all to work out right, and then I make stupid mistakes like that. All right, well, that should fix that. Display setting. All right, this is Jeff Scott, and welcome to today's webinar. It is April 13th, 2014, 2 days before taxes are due. Title for today is Time for a Bounce, but I should have put, or will the bear cometh anyways? We'll talk about that on the next slide. Lots of evidence that we should see a bounce over the next 3 days, but at the same token, obviously news events can change that. We see the bear lurking, and down on the bottom, for those that are Mets fans, those are the Miracle Mets in the late 60s that actually won a World Series. And allegedly, they coined the phrase, the term rally caps in baseball. So they've got the rally caps on, and if you're long, you hope the rally caps are on for you as well. So the problem is, will we get a bounce, or will the news kill any attempt? And the news is going to really be about what's going on with Russia and the Ukraine, the massing of troops on the border, and the potential for unrest here. I didn't realize before how you could actually bisect Ukraine into two halves. I'm sure the Russians are well aware of that. It'd be interesting to see what their intentions are. Clearly, massing of tanks on the border is not a good thing for the stock market. And it's kind of interesting, I guess I could put it, that when you think of the warmongering Russian symbol, it's a bear. And will that bear drive our markets into a bear? I guess time will tell. Disclaimer, as usual, this is for educational purposes only. I'm a doctor, not a broker. Most physicians lose money with their investments. And I am independent, and I paid for all the tools that I use. My goal is to teach you to be your own guru. And I'm not a guru, as Ian would have told you the same thing when he first met me. But he drove me to become my own guru by educating me and leading me on to other smart folks that might help me become a better trader. So I've done this slide 1,000 times, so I don't see the need to spend a whole lot of time on it. I'm sure you'd rather see me go forward. But Ian and Ron, Woodward and Brown, Alexander Elder, O'Neill, Morales and Catcher, Jesse Stein, Mark Minervini, Bigelow, Tharp, and others. Here's some of my favorite websites that I've used to turn me into the trader that I am and to help me make money. I have a lot of tools. I usually hide my desktop for a reason, and that's because I don't use most of them. I need a real-time platform. I'm sort of hooked on two, Thinkorswim and TradeStation. Thinkorswim continues to have server issues, and I do much better with my TradeStation Radar. If you don't have TradeStation, you need to think about getting the Radar platform, and you can always get free TradeStation Radar for life with a nominal deposit. I use HGSI for my market analysis and stock analysis. It's an end-of-day program. I use EdgeRater to supplement that. I am a big seasonality fan, and I like Magenta Trader, also best choice, although there's differences in the program, and I think Magenta Trader does have a much more modern interface. And then I do use MarketSmith. They've got great fundamentals and some scanning, searching functions as well. Always show you this slide, and we continue to live on this shoulder here, where every time I think we're going to fall into the abyss of stage 4, we bounce back up. And you know, we've fallen pretty deep, and the question is, do we have more to fall, or are we about to get a leg up? Because there are a lot of evidence that we're getting close to a bounce. The nice thing is with HGSI, and you all have your favorite programs and favorite indicators, is that there's a suite of tools that help us understand where we are in the market. And then based upon the firing of these tools at various times should keep us in the market when we want to be there and help get us out at the wrong time, at the right time rather. We don't want to be there. Now, this is an old slide, and I'm in the process of doing my own independent research to document it. Now, one thing I notice is that when the market is up, and I usually look at the spiders, then my stocks do well, and IBD 50 does well, and the HGS 100 does well. Every once in a while, there's a divergence between the big stocks and little stocks, and if the NASDAQ does well, then my stocks really do well. And when the NASDAQ and the S&P diverge, then I might underperform or outperform based on the direction of the S&P 500. This goes back probably 15 years to a group in LA, outside LA, that regularly met to determine what stocks were working in the market. The same people, month in, month out, putting together a list of stocks that they wanted to follow, that they thought were opportunities. And one of the folks actually kept track. And then they looked, after 15 months of keeping track of 15 watch lists, they looked at the impact of the market on performance. And I've shown this before, and I'll show this again. And like I said, I'm actually updating this with my own data. But in a strong market, these stock pickers did incredibly well, and they did incredibly horrible, 50%, 32% down over a 4-week trading period in a weak market. Now, since they're the same people picking stocks with the same basic philosophy, one has to wonder, is it them, or does it really show the benefits of a strong market? And I think the message is quite clear. It's tough to make money being long in a bad market. It is tough to make money being long in a bad market. The other message here, which is quite interesting, is that it looks like the big benefits come right away, and that waiting that second month of trading, or 40 trading days, actually hurt returns on the shorts. And in the mixed week market, maybe you had a turnaround because they actually improved, held longer. But as the market maintained weak, they got deeper and deeper and deep poo-poo on the selections. So the best story here is buy stocks when the wind is at your back, and don't be looking to go long massively in the setting of a week or mixed week market. Now, one of the things that we do in HGSI land is we create our own indices. And this was an index of canaries. You can see what they are in the little boxes. And this list was created probably a year ago and was a list of the leaders in the market at that time. You know all of them: Priceline, Apple, Google, Netflix, Tesla, LinkedIn. And the intent was to figure that you might see the market rolling over when these rolled over. And clearly they led the market, and they've been trashed for probably the better part of 3.5 weeks now, right, well over a month since they topped, but below the 50-day moving average in the back half of March, right about the time, I think, of our meeting. Now, the interesting thing is, last week I gave you the dead canary because they clearly had died. But are they stabilizing here, and is a bottom being put in? I think it's probably a mixed story. I think that LinkedIn probably goes down further, but has, for example, Facebook put in a bottom moving north. So I get the sense that the pace of the descent, even though the overall market sentiment is pretty negative, and your guts are probably pretty negative after last week, canaries look like they're putting a bottom. This is a list from October. Similar story of putting together a list of leaders. This is a bigger list, trying to give a better representation of the market, of things that were strong in the third or fourth weekend in October. And that list broke through earlier this month. It broke through the 50. It, too, is testing what I would say is support. So it, too, looks like it might be looking to put in a bottom, at least on this picture here. You could open up down 500 points tomorrow if the Russians move across en masse, and then all bets are off. And then we put together another list. And again, the stocks are listed here as well as their industries in the March meeting. And you could see, even with the big sell-off, those leaders are holding above the 50-day moving average. And all of these, I believe, closed with dojis or with doji-like patterns. And a open up from that doji could be evidence that we've got a short-term reversal. Market themes, clearly we have a broadening of the pullback beyond just momentum. We're on the verge of 8% in a number of indexes. time for a key reversal, or does the bear lurk? And I think that's a very important question, because if we break through the 8, we probably go down to 12% or more. High beta stocks still having a tough time. As we all know, the market's in a tough place here. However, I'm going to show you some signs of potential reversals. I think the strongest evidence would be in my bucketology. I should have put bucketology, not marketology. I put a note on the board Friday about a record low number of sprinters and those that had daily and weekly bondos. These are even record lows compared to the black swan days. Sentiment perhaps has gotten too bearish. Then think about it. When have we had a big market correction or bear market when there wasn't rising interest rates, expensive oil, or an imminent recession? Interest rates remain at extreme lows. Oil and gas, stable. You know, we're talking 103, 104 on oil as being expensive, not 120, 130, 140 anymore. Gas is up, but it's still cheap compared to historics. And then the rest of the world potentially starting to recover. How am I playing this? Last week, I continued to raise cash by selling stocks that were laggards or rolling over. I'm out of margin. I bought more contras. And as I've been talking about over the last several weeks, I bought a number of married puts on several existing long-term gainers. And then I'm waiting for the market to put in a bottom, because once it does, wherever that bottom is, I'll start selling the out-of-the-money puts below that bottom to gain premium. And once we get a little bit of a run-up, I think the run-up stalls, and I think it will stall, then I'll start writing calls against my long position. The goal is to generate premium while I'm in a position that I can't lose money in these holdings. It's actually a good feeling to be in, frankly. And I thank the person who I met out in Orange County who pointed me to a website and where I got a little education in that, and timing was everything. This week, I will let the market dictate what I do, not what I think the market should do. I would not be surprised for a big drop at the open and then hopefully a recovery. I was on the phone with a support call with someone in the HGSI universe who got my trade station indicators I was setting up on her machine. And I said, oh, yeah, we might see it open up 1,000 points down on Monday. I think I scared the daylights out of her. I wouldn't be surprised for you to wake up and see futures down 15 or 20 points. And then I'll tell you, once they stabilize and start to turn up, I think it's time to start thinking about opportunities, because I expect a big drop in the first couple of days and then potentially a recovery. It could be a big recovery. And again, not that I want to be going out on a deep limb. Would it shock me to see us take out our most recent highs before a major rollover into the summer? No. No, we didn't end this full run with exuberance, parabolic melt-up. And we might still see that in the next few weeks, although long-term I'm very nervous. Because I think the market still has more room to go, at least short-term. I held my contracts over the weekend. I'm ready to sell on open when market trades up. I've built my list of box 1, 2, and 7 stocks, which we're going to talk about today. These are a critical HGSI feature, and I'm going to continue to sell premium as I can, trading the bounce. So I finalized the story here. I urge everybody to attend. Of course I do, because I don't want to end up paying out of my pocket for all the guarantees. But June 21st to 23rd, you'll come in on Friday, which is the 20th. Meeting will be the 21st and 22nd. My goal on the 23rd is to have minimal didactic and a lot of in the market, showing what I do, maybe go to a couple of chat rooms that I use to show you what I get out of them, and at the same time watching the radar screens and market watches and doing some intraday trades if the market is conducive. I've decided you all deserve a break, and rather than stick you out at an airport hotel, we're going to do this at a resort. The resort is a short drive. It's a 15, 18-minute drive from Palm Beach International Airport. It's about an hour from Fort Lauderdale. It's the Marriott Spa and Resort on Singer Island, Florida. I'll have the finalized rates after I go over there tomorrow and sign the contract. It is beautiful. It is 2 doors down from where I live. It is on the beach. And there is more to life than just charts in computers. This is not just an HGSI meeting. It's not for people who, only for people who are HGSI experts. I think HGSI is a great tool, and my hope is that people come that are users, but I also want people to come that are ready to be a user. So I will do a couple of webinars in advance, mostly around vocabulary and the logistics of the software program to get some of you up to snuff. But this is really going to be about how I and others use HGSI and other tools to make money, and other tools included. And the goal is to get you on the road to be your own guru. That's the hotel. That's the intercoastal. The other side is the ocean, which is over here. And it's really lovely, and I live right here. Ocean's Edge is where I live. Here's the hotel. The rooms are in about the 190 range. There's a Hilton next door that's, I think, a little bit cheaper. And actually, I'm going to look at that one just to be certain tomorrow morning. And then people that are signing up know that they have to wait until midweek to make their reservations. Jeffrey at highgrowthstock.com. If you have any questions, and love to have you, and we're going to limit the size. Topics: HGI Unleashed, maximize the software and the principles that drive it. How I use other tools. These include EdgeRater, TradeStation, Thinkorswim, Magenta Trader, anything else that's on my computer, frankly. It'll a lot be about top-down investing, looking at market, sector, and industry rotation in stocks. As I always say, I can't ever resist doing some bottoms-up investing. So we'll be looking at some stock picking, a lot about what trade to make using some of the back testing features in in Thinkorswim. And if you are a VectorVest owner, you might want to come just so I can show you their new uber expensive options program, which is pretty darn cool, actually. And I think I'm going to try and do some discussions around stop losses and money management. This is mostly going to be about stocks and equity options. I do trade some futures. I don't think that's what we're going to talk about, except for how I use market internals and futures to understand what the market is doing. There's some of the tools we're going to use. The meeting is not cheap. I don't think I think it's very cheap, but it might be more than some people are used to paying at $8.50. But that meeting that fee includes breakfast, lunch, and snacks on 3 days: Friday, Saturday, and Sunday. I'm paying for high-speed internet for everybody in the meeting room. I will be taking everybody on my treat, as I did in New York, to will probably be an over-the-top dinner on Saturday night, and then we're going to have cocktail parties on the pool deck. So I'll open up my wine cellar on Sunday Eve. The price, let me actually hide this thing, is, as I said, and I don't even think it's pricey. And I try to do this at a relatively fair price. I think people know that I don't really do this to make money. I enjoy being on stage. Let's face it, I love being on stage, and I like to give back. So it's $8.50 for everything above. If you want my indicator set, which I typically sell for $600 or $650, I charge $250 to people that attend my live meetings, so it's only $1,100, including the indicators. I'm not going to spend any time here, but I saw this as I was looking around. I rejoined his chat room since I'm becoming a chat room addict. And I thought that Dan Zanger, who's a trader, who's made a lot of money, has some really good points in his top 10. You should have sell rules, hold your strongest positions the longest, identify and follow strong groups of stocks, keep your selections in these groups. Talks a lot about volume. And he's not a big fan of margin. I'm not against margin, but you got to know what you're doing. And being in margin during a downtrend is like jumping out of an airplane without a parachute. You only do it if you want to be slaughtered. So this was the market last week. And it's interesting because it felt really ugly here. It felt even worse in Japan. We did better than some of the pigs. Portugal was minus 4.3. Greece was minus 4.86. But we had a horrible week. NASDAQ was down 3%, the Russell 3.6, the NASDAQ 100 down 2.6. And you look at some of the winners, China was up. Must be some talk about easing. Brazil, I think Brazil is one of the strongest places right now. Maybe it's the resurgence of the BRICS. But the point here is it was not 2007 and a worldwide meltdown. We had the worst parts of it, perhaps us and the Japanese. So you'll notice the IRW, so let me give credit where credit is due. There are certain things that I have learned from Ian Woodward that have made me a lot of money. The high jump bar has saved my ass. The boxes have given me a place to fish where you make more money by fishing where the big fish are. So it's very simple. At times of reversals, reversal over reversal over reversal, Ian has demonstrated that by buying stocks who meet the box criteria, you get an outsized return. The rule of 72 is you take the growth rate into 72, and that is how many years it takes to double. So 100% growth rate, or anything more than 72% growth rate, you double in a year. So the boxes are determined by current earnings percent growth rate the last 2 quarters, across the top, up and down, annual over the last 5 years. So that means you're not going to have new companies that don't have 5 years of earnings growth. And if you find a company that's grown for 5 years at over 50% annually and has 100% quarter-over-quarter growth the last 2 quarters, you got a fast-growing company. That's a box 1. You expect that to double in the first year. And then so on and so forth. A box 5 is a double in 2 years, and a box 9 is a double in 3 years. Frankly, even a box 9 would be great on some of our portfolios. That's a pretty darn good return. I have found historically that I made the most money in box 7s. They stubbed their toes over the annual, but their most recent quarters are strong, and so their same-store comparison or their year-over-year or quarter-over-quarter comparisons are quite favorable. And I love box 7s. Box 10, we used to call them consistent turtles. They'd be the Gillettes of the old days. I guess these are slow-growing, interest-bearing stocks, but I'm not sure we have box stuff or their mattress stuffers anymore. And then for those of you that are scared off by any volatility in the market, there's always box 11, which is cash. I will show you a 3-step process to create these boxes. And then you monitor them. You start to look for new highs and breakouts, and that tells you it's time to begin the market. Or you buy a basket of them when you see a reversal. So here it is defined again. And again, stop it here. Write this down if you don't get it. And then go out and build it. Now, if you have any program besides HGSI, you can do this. You can do this in FinViz. You can do it in MarketSmith. But why not do it where it's done for you and where it's automated so it saves you time to go make money by finding the right stocks? Couple of examples, trying to go modern era. We got examples all the way back to the 90s. The market had a reversal somewhere around April 28th of 2011. That reversal ran up until September 1st. Excuse me, we back that up. The market bottomed, had a reversal on September 1st, 2010, and it ran up until April 27th of 2011. So it started September 1st, and it ran to April 27th. So the peak of the market was on the 29th, and over that period of time, you could see that the S&P 500 ran up 24%, between September and April. That's 7 months, 8 months. That's a nice return. Now, the interesting thing is, if you look at the box stocks, okay, ERG of at least 255. So remember, ERG, earnings, relative strength, and group rank, 0 to 99. You take the three numbers, you add them together. So those that were above 255, there were 81 of them. When you divide them up into the 7 boxes, you could see that box 1 was up 125% in that 8-month period of time versus 24%. Box 7 stocks were up 106% in that period of time versus the 24%. Another way of looking at it here is you could see the relative performance of the S&P 500 versus the various boxes. So wouldn't you rather have been in the boxes? These were the returns from 1 through 9. Box 7 being up here at 106, 1 and 2 being the highest. Wouldn't you rather get that 125, 109, 106, or 105 return than 24%? Of course you would. Now, by the way, there's no chart picking here or stock picking. You bought each one that was in the boxes, and it shows the return that you got over that period of time. Percent change since September 1st. So, a year ago, let's see if I want to get it right. Yeah, so this is the second one I wanted to show you. This is looking at HGS boxes. The ERG was set at 240, and this was the list of stocks sitting on June 23rd of 2013. As you can see, I think we might be very close to what the market looked like there. And what happened between June 23rd and August 14th? 2 months. If you weren't a box stock, you still did great. You were up 16.4%. But you had box 4s, 5s, and 2s, and 6s with great returns. And so I would argue that being a box stock, although not as great as some of the others, led to outsized returns. Now, you're not going to buy the entire stock market, but here you're buying stocks that were leaders. So if we're close to that reversal point, we might want to build out our boxes here. And now I'm going to give you some pictures that I did, I think, in TCNet real quickly that give you some of the ideas why I think we might be near a bottom or maybe getting closer. In HGSI, I like to look at percentage of stocks and how they compare to those above the 20, 30, 50, and 200-day moving average. Here you can see stocks, 40-day moving average, the percentage of stocks above it in green. Here you can see the S&P 500, and you can see each time when you hit this bottom, you hit this trend line, you had a reversal on the S&P 500. We are right above this trend line. We're within 1 or 2% to hit this trend line. Now, unfortunately, if I switch to a weekly chart, you'll see that in the past we got much lower before reversals. But in the QE world that we live in, this is what we've seen, and we're getting very close to that point of reversal. McClellan Oscillator versus spiders. When we get a pullback in the McClellan, we usually get a bottom in the market. Bottom, bottom. We've pulled back to where we've seen some minor reversals or reversals of late. Now again, that's probably evidence that we're getting closer, perhaps still have a ways to go on the McClellan. Now you notice that the scale goes to about 280. If I was looking at a weekly, there's some times in 2011 when we got to minus 430. But to me, evidence that we're closer to a bottom than we are to a top. The Commitment of Traders report. I'd like to point out this period of the map here, where the yellow are us, the blue are the hedge fund guys that are smarter than us, and the red are hedgers that I ignore them because they have different reasons for doing what they're doing. So on the whole way up, we were buying, and as we got closer to the top, the professional guys had pretty robust selling. As the market rolled over, we were still buying until we got close to a bottom when we went net short and the professional hedge funds started buying. So the folks like us did not catch the initial part of the bounce, and we're out of the market the majority of the run up. And what we see here on the right edge is that the individuals like us have been pushing the market up higher, and you can't see it well here, but the professional guys were short. The interesting thing is I think there's a lot of indecision now with this pullback because we've pulled back our buying and the hedge fund guys have gone near neutral. So it may be that this is indecisive commitment to traders report might be more evidence that we're getting near a bottom. How about volatility? You can't see it probably very well. Like I don't know what you can't see, but there's a red line here, which is the NASDAQ. This is the VXN. And like the VIX, this is looking back weekly, we're at a recent high, okay? So we are at a point where we might expect a bounce. And every time the VXN spiked, the NASDAQ pulls back. Now the interesting thing is this is a weekly chart, and obviously how volatility is perceived in the market, maybe how it's calculated, maybe the impact of quantitative easing. This is nothing compared to volatility of days of yore. But of recent times, we're at a point where the NASDAQ volatility usually starts to turn down and the market rebounds. The VIX, easier to see in yellow, similar story way down below where it's been historic. And then the other thing I wanted to point out, I just put these together quickly, TNX -X is a yield on the treasuries. And the treasury yields looks like it's in the 2.6 range. That's very low. Now the other thing that I thought was interesting here, and I haven't done enough of my own research to say if it's meaningful, is the stock market kind of looked like it was following treasury yields. And there's been a disconnect with the stock market going up and the yields going down. Now, thinking about it, low yields should be good for the market, but not low yields because the market thinks that the economy is going to die. Low yields are certainly good for certain stocks, the REITs, the MLPs, the utilities, the big dividend payers. And I'm sort of perplexed, and I'm going to do some more research about that relationship. Bottom line is that one of the things that could drive us into a deep correction is a high interest rate environment. Nowhere to be seen. And now that I'm retired on a fixed income, thank God fixed income does not mean you can't invest in stocks, and growth, and in dividend payers. If you're on a fixed income and your money's in a CD, you're toast. So market thoughts, will we bounce or not? Is there a bull trap? And then we go down further. I think risk is high. Cash is a position. Trade smart, that means small positions. You marry your spouse, not your stocks. Stop losses, no margin, and be nimble. Themes that are working now, oil and gas. The top of the market is all energy. Interest rate plays, the REITs, the MLPs, utilities. And Brazil remains strong. Banks, ore, energy, utilities, and food. You would think there's going to be some huge government spending coming into the Brazil market with World Cup and Olympics coming, so that might be what's driving it. And now let's go look at the charts. Now I spent an exuberant amount of time, I know, on this PowerPoint. It's kind of worthless, to be honest, to be doing much stock picking until we understand what the market is doing. And to me, that's the critical thing right now. Let's look at some things I got for you in the market. So I always like to look at what happened last week, so Friday to Friday, end of day to end of day. Equal dollar value, so my numbers may differ from yours based upon how I set my calculation on that. And you notice there's three groups with black. And there was only one stock in each of them that were up. That means the rest of my groups were red. So the market was a tough week. Now the stocks I shorted, or I picked to short, were down 4.41. That would be a positive return since I was shorting those. The code red stocks that I saw over the weekend were down 5.03%. So HGSI has some really great tools, including things that are done for you between code red, the stocks and groups to the downside, the cheap stocks and groups to the downside, all of which identify 5 or 6% returns. Again, the minus 6% is counter because this is only looking at if you bought them. Had you shorted these stocks, you have had a huge return. I said high beta stocks are getting killed. They were down 7.32. A lot of our favorite things like Bible gap ups, breakouts, green candle lows, top relative strengths, best stocks, estimate beaters, all got clobbered this week. HGS 100 was down 3.75. IBD 50 was down 3.46. The stocks that I put on my buy list, but just like this week, I'd be reluctant to buy anything without a market change. They were down 3.27%. The S&P 500 did a little bit better because, as we know, this was a bad week for small stocks. If you're a fan of the Hindenburg, you can see we had some in December, and we're getting close. The problem is you've got to have over 2% new highs to be there, and we're nowhere close to 2% on new highs, so there's no Hindenburg close. Bucketology, this is kind of interesting. Here we are, 4/11/2014. We're now over 30% of stocks are trading below their lower Bollinger Band. Looks just like it did last year tax time on April 15th, where it was about 30%. How much more oversold can we get? So let's look at a couple of market swings. April 10th, which was a day earlier, we were 18% below, so we've gotten markedly worse in one day. February 3rd, we were 45% underwater, right, or below the lower bands in the S&P 1500. So we could still sell off quite a bit further. January 27th looked a lot like it looks right now. October 18th, the days of wine and roses, 35% above the upper Bollinger Band. That was a peak for that cycle from a buckets perspective. September 18th, 30%. June 24th, kind of where we are today. And then January 2nd, 2013, again, wine and roses up 40%. So I decided to look at the market and try and get an idea of, do these things actually mean anything? Or is it just more hocus pocus and we're playing with you? So I went back to start with to the end of 2012. So we had a pretty deep correction that ended middle of November, and then we had an all-clear signal breaking out above prior highs in the beginning of January. And you could see we had a huge run-up with minor pullback here to the 50 running until the middle of April. This is what the bucket showed us here, and this was the highest green of that time. 40% of the stocks, even though we were already breaking out and had a big run, were extended. So message number one, it doesn't necessarily work to the upside until you get to massive extremes, because this was extreme and we continued to trade up. Back in that April time frame, we had a low come in. And about 3 days before that low, we were at 30% below the S&P 1500 stocks. So what this means is that 30% of the stocks in the S&P 1500 were trading below the lower Bollinger Band. So to me, that might mean something. And we had a reversal in 3 days. Let's see what happens. Market ran up, pulled back, and this is clearly a reversal candle. And what did we find? On June 24th, we had 34% of the stocks in the S&P 1500 trading below the lower Bollinger Band. We go to the next up arrow or green arrow. So we're now in the middle of September, and we had 30% to the green, and the market did sell off. In October, we had 35%, and again, the market continues to chug. So I'm going to, from now on, not pay much attention to the greens because obviously they're not working. We've got another red signal coming in here. We've got a couple of them. We've got January 27th, where we got over 30%, and we've got over here February, I think, 2nd, where we're also, I think we're about 40%. And so the first one was early. We had a little bump up, but give it 3 or 4 days, and you had a real bottom with the second signal. So again, getting above 30% shows that you're getting close to a bottom. Ran back up, pull back down here, and this is where we sit. And does this not have an appearance perhaps similar to what we saw back here? And this is at June of 2013, where I looked at some of the results from the bottom, from putting the buckets together in a buy list for that period of time, or the boxes rather. So I look at this and I see something that makes me feel like a reversal is probably close at hand. I could be wrong, and we could pull all the way down here, which would be extremely painful, which would be another big drop in the market. Speaking of the markets, these are a number of major indexes. The first column are looking for kahunas, which would be a light color is a 0.24, dark color is a 0.4, which is a percentage run within the Bollinger Bands. The darker the color, the bigger the run. This is looking at the current percent B of the various indexes above 0.7. So in the upper quarter, it's green. Below 0.3, it's red. It's yellow in between. Just try to get an ebb and flow of where the indexes fall within their Bollinger Bands. You can't see it well, but a lot of uptrends, they get above the 100% for a while. This is the bandwidth, and this is a mathematic relationship between the bandwidth and percent B, and this is really our timing methodology. And what we see is we are in deep red, which is very bearish. Now, the interesting thing is we're in deep red after we've had a pretty strong sell-off. And when I look back, sometimes this is a last gasp, deep red. And it's one thing when it's at the beginning, but occurring deep into this sell-off, this might be indicative of some babies out of the bathwater selling. And could be we might see some yellow and some blue come in this week, or green rather. Partly why I think we might be seeing getting close to a reversal. I can blow these up actually, I forgot. You can see that there's a lot of minuses here. We get several minuses on these indexes, which means some of these major indexes are trading below the lower Bollinger Band, which are places that you would expect a reversal. And this perhaps was a little bit too much bearish exuberance this week. It'll be interesting to see. All of these, by the way, are done in EdgeRater, which automates a process that used to take very long periods of time. Within EdgeRater are George Lee setups for weekly and long. And for Morales and Catcher fans, this thing called Code Red. I showed you early on that the Code Red stocks were down 5%. I was just kind of boring. I just went here and I said, I'll take all the stocks that had a kahuna to the downside. Yep, there we go. And those were the stocks that I took last week, and I put them in a watch list, and I traded off those stocks. And as you saw, as a whole, those stocks were down 5% for the week. If you think the market's going up, there's a code blue, but good luck on that one. Although, we will get a reversal eventually, and you can see you've got volatility and you've got contras and volatility up here. So not things you'd like to see of a market taking off. I think ETP was one of my long picks for the day. I think it's a MLP, if I remember correctly, or something that's interest-bearing. We'll see that later on. I like to go quickly and look at my elder indicators within So a couple of things to show you. Again, it won't project well these colors. I'm still playing with them. There is a free TradeStation earnings ELD posted on the TradeStation forum. Search for the guru. So automatically it updates and tells me when my earnings are coming out and how long before it happens. Titan came out this week. These are some of the stocks that I'm looking at as potential longs and shorts. You want to be careful of buying and selling at periods of time when earnings are imminent. But I want to look at my elder signals, and let's just look at the majors real quickly. Here's a NASDAQ really knifing deep below its envelope. You know, the more it stretches, the more likely it's going to reverse and reverse powerfully. But right now you're red on the NASDAQ, on the daily, the weekly, blue on the monthly. Interestingly, you haven't taken out the low here yet, so I can't say anything about a divergence. But you're probably not going to be divergent since your lines are already getting lower than the prior MACD, the low of the prior MACD at the previous low. So NASDAQ is clearly beat up. It's going to take a move up before I'd be even interested in buying anything. As I look at the Dow, not quite to the lower envelope. Weekly red, blue on the monthly, red on the daily. Spiders, same old, same old. So clearly you have a lot of sea of red, of a lot of ugliness. One of the things that we're going to be doing at the meeting, live meeting, is we'll be watching my radar screen and other additions that you may have or suggestions. And I'll sit in the morning tomorrow, for example, and I'll have a number of charts up on futures. And the futures aren't open yet, so I'm not even looking. I'll be watching the E-minis. I'll be watching a whole list of futures on an intraday basis. But I'll also have a monitor that's just going to have my radar screen. I'm going to look for Bible gap ups, and we have Bible gap ups in FAZ and TECS on Friday. That can't be a good thing for the market, but these things are so volatile they may go the other way tomorrow. I'm going to look at what the 3Xs are doing, the bulls and the bears. I'm going to look at what the sectors are doing, who's leading. And we all know that utilities have probably been the leading sector over the last several weeks or longer. No shocker because of their interest bearing. These are some of the stocks I have long and shorts, and I'm watching closely for various reasons. I obviously don't own all these. I've cut back the stocks I own. Several of them are the ones that I've got collared, so probably doesn't matter what it does for me. And then I have a list of about 600, 700 other stocks that I call my tigers. And I'm going to be watching them for Bible gap ups, how the volume is compared to normal, and then throughout the day looking for green candle lows and red candle highs. And you'll notice not a lot of red candle highs, so evidence that we're probably getting closer to a reversal. I'll be looking for mobile breakdowns from a squeeze and mobile breakouts. We haven't had many breakout yet. I'll be looking for candlesticks and a few of my other goodies. And this is stuff that we'll do at the live meeting. Those that purchase my TradeStation indicator package either at the meeting or separately will get everything that I've showed you from here over, and pocket pivots as well. Looking to see intraday who's got a pocket pivot up. A lot of pocket pivots up on Friday for such a bad day, but also a lot of pivots to the downside. So that all comes with my indicator set. And in addition, each of these indicators I use in my charting. And I have this thing called my dots, which is sort of like what I use in HGSI, where I have my Bible gap ups, my mobile breakouts and breakdowns. I have after pocket pivots. I have PSAR, I have squeeze, PSAR, red candle highs, green candle lows, and forced kahunas, so that I can look in multiple time frames and get an idea of what's going on either with the dots or I can actually plot them on the charts. That's it on the advertisements. I only do that there because I get a lot of requests. Let's go into HGSI and see what we can figure out. I got to reset the size because my monitor that I use is quite a bit better resolution than what I use for these programs. If I use my full resolution, it'll take you 3 days to download them, and YouTube will kick them out anyways. All right, got that. So what I like to do, let me open up my warehouse view. I'm just position sizing for this monitor. My hope is after my meeting in Florida that you guys can do this better than I can. And even if you've been using HGSI, you'll go home with, except for your name is Ron Brown and Woodward, you'll go home probably with skills that you didn't already have. And if you're a newbie, just do the webinars that I do beforehand so you don't get left behind. And we are going to do live trading at this meeting. Let's open up my chart. So now I'm going to take you through a little bit of what I usually do for my traditional top-down approach. So first thing I'm going to do is I'm going to go into the Woodward and Brown user groups. They were updated, by the way, today or this weekend. And I haven't updated them yet here, I don't believe, so I've got to still do. Actually, the user groups weren't updated, his filters were updated. Major Markets Plus, I use what's called a top-down view, and this is looking at multiple weeks of price and volume heavily weighted towards yesterday, or Friday rather, and the preceding in the current week. And it gives you an idea of what's working, what's not working in the market right now. No shocker, it's a tough market for stocks, bonds, gold, oil, volatility, commodities, utility are up at the top. What's not working are small stocks in NASDAQ, bigger stocks doing better. If you look at one-day performance, you could see that volatility was up big at 7.2%. Volatility, which has helped my VXX, was up 22% for the week. Tough to make money when volatility goes up that way. You see the Russell was down 3.6. Mid-caps were down 3.6. NASDAQ 100 was down another 2.6. I like to look at these very quickly. And since, well, we'll leave on there. So here is the S&P 500. So if you're a long-termer, you've had a great run-up. And the issue is it time to get out, time to get back in, time to be fear, time to have greed, or in the words of Kenny Rogers and Ian Woodard, know when to hold them and know when to fold them. We've had a pretty good pullback here. From the high to about the low on Friday, we've had a 4.3% pullback on the S&P. I don't know about you, but that's not exactly a big pullback. It feels worse because we probably buy a lot of high-growth stocks and technology stocks. You had a a Phoenix on Friday, which is calculated on the NYSE, or in this case, we changed to the NASDAQ because of some reevaluation of the index. But you could see that's a bad thing for the market occurring on Thursday. We had followed through on Friday, but we're only down 4.3% from the top. As I prognosticate about where we're going to go, and this is just prognostication, guessing. So let me do a couple of things here. So the 200-day moving average will continue to move up. But the 50-day moving average is probably going to start to trend down a little bit. So what are we going to see now? Are we going to see an immediate correction down to 1771 and then a bounce? Well, I think that's possible. But I also think that'll be extremely painful for anybody that isn't net short or neutral. Might we see, let me put this line in here. This is using this as a potential support it was resistance, and then it was support. Might we see a pullback to that line in a move? My bet is we see this tomorrow. And then the question becomes, do we get a bull case and take out new highs before a rollover? Or do we get the bear case and then go down and reach the lows? I have no idea. My guess is that we don't trade straight up from here and that we have that pullback at least to start the day. But it remains to be seen. This is probably my deep support there. And from my closing price to that 200, it's another 3%. That gets us close to that 8% correction. A lot to do about nothing, perhaps. The S&P is not sold off hard yet. However, can't say the same about the NASDAQ. So even if you're a long-term bull, and I'm going to make this cleaner for a second, the NASDAQ is sold off hard from its peak. It's down 8.6%. So we know from Ian that the majority of corrections do not end at 8%. So if we don't see a bounce back, what is our targets? We could run down to the 200, which is still going up, I think. And that would be only another 1.1, so it only takes us to a little bit less than a 10. Let me shorten this up a little bit. Here's our low, I'm going to call from November 2012. I'm not sure if that's the right low, but you don't pay me, so I'm just going to guess that that's the right low. I'm going to go up to the peak here and see if I can't see anything interesting on the fibs. 23.6 line we're on right now. That could be a natural reversal point. The 38.2 has got to be my next target if we don't hold here. So that would take us, whoops, wrong one. That would take us, get my bearings again. That would take us down to about 37.95. That would be only another 1.3. That gets us to a 10%. As I look across here, I notice that the 50% line served as support. Two different pullbacks. And from the peak to that 50 is 18%. From the peak to the 38.5 is 14%. From the peak to that 50 is a little bit less than 10%, or that 200 is about 10%. Pick your poison. I think you're ending up, my guess is we pull down and bounce off that 200 tomorrow, or get close and bounce. I sure as heck hope that we don't get down to these fib retracements. I just noticed that the UN is calling an emergency meeting tomorrow about Ukraine. This could be really wicked, but you know what? I hate the market we're in, so it might be that a big rip-roaring pullback tomorrow, and then Tuesday might get us to a place that we'll get a nice sustainable bounce from. Ugh, I hate talking like that. All right, what else can we look at? We can look at the Dow. And I'm not going to spend the same amount of time here because, you know, kind of like the NASDAQ heading down towards the 200. The Russell 200,000, I mean, like the S&P 500 there. The Russell 2000 Worse than the NASDAQ, already down to the 200, a place that you'd expect it to bounce, although the last time it got here in 11, it wasn't held there. We look at things that are working. The VIX, we had a VIX spike this week. I have a lot of VXX. I actually wrote calls against my position a couple bucks ahead of where we're at because I think we're closer to the end of this than the beginning. I still want to capture that premium if I can. Can look at the dollar, still down in the dumps. It's hard to believe that we're not seeing more out of gold and silver. If you look at gold, the dollar in the dumps, back above the 50-day moving average, that's bullish. If I look at silver, and Stillwater looked interesting this weekend on my review as one. It doesn't look as good as gold. It's still below the 50 to 200-day moving average with the same type of a pattern. So, in summary, actually, I think that NASDAQ slide is everything to me. It gives me a couple of way downside targets, and it plays into my theme that we've got a little bit more to go before we bounce. Next thing I want to do is see if any industries are actually working. Unlikely for that. 149 to start. Yeah. Worse than I would have thought it was because there are some things working in the market, in the energy, and the other places. Diversified support services, UBIC. I looked at this one. It's one of the stocks I looked at today. That's real clean, but I need my goodies. And I see a stock that's a little tiddler. It's an IPO. It makes no money, and it's very extended. Interesting picture going back. Yeah, it's not. It was an IPO in the middle of last year. Give it some more space. Whoops. It's had a beautiful run. What does it do? Computer processes and data preparation. International. Well, big Bible gap up here potentially, and a continued run up. It's anything that's gone from less than $2 to $12 in a month. It's not named plug. I'm not interested in it. So a little bit too much, too fast for my taste. Only trades 170,000 shares. Electrical components and equipment. Speaking of the little double, I made a lot of money on this stock. It had some great opportunities to buy into it. You had a stock that was squeezing here. It didn't make the yellow color. With a kahuna, MOBO, and a gap up here, and a PSR reversal. So that was an opportunity, forming the left side of the cup. I got into it back down here on the right side of the cup where you had kahuna, MOBO breakout, and everything turned green. I got out of it. I got stopped out on this date. Thank goodness I was sitting in a meeting. Yep, that's the Monday. Maybe it's setting up to go again. Got a little bit of a wedge coming in here. I mean, I think I'm going to discount that day in making my wedge and maybe just look at it a little bit like this. But you might break above this. The stock is a very volatile. It's a day trader's delight stock, and it's had some crazy volume days. 19 million. You go back in the rah-rah days, it was 84. There was one day it was 109. I think this was 190. 212 million and 244 million shares traded. Gotta be nuts. Don't buy that stock. Amtech. Hard to be excited by this. It's in a downtrend, so I'm just going to skip it. Well, in a long-term uptrend, but it's knifing its way down. I don't really see any reason there to be excited. It just tells you we're not going to see anything on top-down to go along with until the market changes. I think the market's going to change. Just it hasn't changed yet. Drug retail, we've been big fans of Rite Aid for months. Got a couple of my different portfolios. And why not? Rite Aid has been in a nice steady uptrend. They had a gap up on Thursday, had a nice day on Friday, pulled down, finished up for the day and above the bottom at the close on Thursday. Mobile breakout, Bible gap up, two kahunas, huge volume. I think it was on earnings. Only thing it doesn't have is a green weekly bongo up here. But my short-term one, I bet, is turning soon. Nope. But we've been watching Rite Aid for quite some time. and continue to like the drugstore stocks. Here's Walgreens. Like to see it get above the 50. You've got sort of the power of three. You've got a 17 and 8 and 50-day moving average coming together here in a squeeze. If you can break above this point, flip your PSAR, you might have a very viable stock in Walgreens as well. All right, so I bet we're going to see a lot of things to the downside if that's all we're seeing to the upside. Forced down. Oops. Should have done a right click back to the industry groups first. No worries. Go to 05. Now this is very interesting. So this tells me that there's a lot of indecision in the market. I don't exactly get it. Why we're not seeing more things with big force to the downside. To scratch my head on that. If I take this out and look at go up here. Just verify that I don't have a bad filter there. Nope. That's interesting. I would have thought to see more groups with a lot of pain to the downside. So let me just go back and let's look at that T and rank them with the top down, because that will take into account price and volume of all the stocks in the group over the last several days. So where is their strength? You'll see a lot of oil and gas, utilities, 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 oil and gas, oil and gas, oil and gas, and then the REITs come in down here. Interest rates are king right now. Hard for me to get real excited about showing you stocks from top down when there's not a whole lot working. Show you some other tricks. Let's say you're new to the program. You want to find my top 10 stocks to look at on the bull side. You go into Designer. We're going to open up Tools, Group Inclusion Report. We are going to set this up before I run it the right way. That includes going down here, make a group for the report. GIF, top 10, April 13th. Only want 10, so that's going to give me the top 10. So the assumption here is I got a lot of good groups up here, and I'm going to find the stocks that are in most of the good groups. We got the sprinters, best criteria, best times 15, demand, growth, HGS 100 leaders, QEPs, stocks and groups to the upside, strong EPS, my breakouts from the squeeze, like that group, pullbacks to 50 with a kahuna, like that group. Then I might look at Morales and Catcher, take his Bible gap ups, take his pocket pivots, maybe come down here and pick the IBD 50, IBD 85, Handsome Select, Market Smith 250. How about some top EPS, top relative strength? Having a weekly and daily bongo is very bullish. Let's pick those. And the top vector vest. I just picked those. There's no method to my madness. Hit OK. And so what it's going to do is it's going to take all those groups, count up how many times a stock shows up, and those that are in the groups from those times are going to make it to the top. So for example, on the bullish side, if you want to be long, or you're looking for things that are doing well, Gaslog, that was a good stock this week. These are all the groups that it found itself in. Gaslog, EOG, Magellan, Diamondback, Continental. Anything in common in my top 5 stocks here. And number 6. They're all energy. Energy is king right now. I can go into the program, and I should be able to find somewhere here these 10. Turn off my filter. And well, they only gave me 6 because that must have been there was a tie. You want to find some things that work? I'll show you some things that work. Here's Continental Resources, makes money, earnings per share growth, lower left, upper right, a number of pocket pivots last week, pulled back to the 8-day, still above the 8-day, heading up. Diamondback, probably like this one better. It's based a little bit, had a pocket pivot on Friday at Kahuna, mostly green above, and had a DMI crossover. Great earnings per share coming in. EOG Resources, lower left, upper right, starting in a squeeze here, breaks out, it has a PSAR reversal. I'll be a lot more interested. These are all oil and gas plays. GasLog is a shipper, had a great day on Friday with a pocket pivot, huge volume, a bunch of recent kahunas. Everything is green, coming out of a squeeze, makes money. This is one of the ones that I put on my buy watch list. I think this has room to run. Holysys is electrical stuff, I think, for the auto industry, if I remember correctly. Maybe not. Digital railway motor drives does have auto industry. Not as pretty a chart. Does make some money, although earnings per share is going to drop in 2 quarters. Don't like this one as much. Magellan Midstream, this is a good example of stocks that pay a dividend, 3.2%. There are tons of MLPs that made it to the top of the list, and I'll show you that in a few minutes. So that's one way to find stocks that are leading. Now, there's obviously more stocks on the list than we looked at, and we could have gone down, and let's look at some of these and make some comments. Don't know this one. Here's that chicken stock that was still highly ranked. More energy, auto parts, more energy, drugstores where we looked at, more energy. There's your plug power. So you can find the best stocks in the market by doing that group inclusion filter. I also do a number of other things. Now, it turns out that for you under smart groups are a lot of pre-planned scans on a daily basis. So if you're a Morales and Catcher fan, take a look at code red or code blue. You want to find stocks to buy or sell? They're right here. So let's open up a warehouse view. Let's go find that code blue. And here's a list of 23 stocks that met Morales and Catcher criteria as being bullish stocks. So let's just quickly look at these. Now, I've got my view on them, but their view, let's go to their view. Morales and Catcher. I got to get rid of those old ones. Secret weapon chart. So what you have on this are bongos, like I use. You have kahunas. You got force. You've got pocket pivots down here. And then you got eurekas and phoenixes. And they like line charts. I prefer candlesticks. So all of these, by definition, are going to have pocket pivots, and they're going to have force kahunas. They're going to have, I think, 4 out of the 5 above being in blue. EPAM's had a pretty deep pullback. It's below the 200. I'm not too interested. GasLog, there it is. Everything's blue. Nice side, nice day, closing the upper half. Pocket pivot on huge volume on Friday. ConocoPhillips in an uptrend, multiple pocket pivots, mostly blue above. Pays a dividend of 3.9%. Diamondback, when we looked at earlier, mostly blue. Up day on Friday, pocket pivot, huge volume, big run up in earnings. Too early in its history to pay a Robinson Worldwide. It's sort of been in a deep pullback, so it's less than the 200, so that might not be something that interests you, but it's had multiple pocket pivots. Everything is turned blue here, and it might be an early buy. This is the group strength line. Turned down a little bit, that might be a negative. Pohang Steel, a Chinese steel company, heading up, pocket pivot on Friday. Probably too extended to be a real pocket pivot. This is a pocket pivot volume signature. It may not have counted because it really didn't come by and hit the 10-day or the other moving averages. This is a buyout. Allergan is a pulling back that crossed through the moving averages, 3 blues and a pocket pivot. Might be a little early. It is above the S&P 500. The point here is you have a bunch of Catcher and Morales type stocks coming up. And this is done automatically for you in the Smart Group. Code red, potential shorts. Take a quick look through some of those and switch to the, well, you're in the code red. Let's see. All right. For reds, big down day, pocket to the downside, equity residential. Interestingly, it pays a 3.5% dividend yield. There's been some news. Proto Labs, a 3D printer company, you know about those, mostly red, pocket pivots down. So you might want to go through here and see if you find something that's pulling up to the 200A that might be shortable. Here's one that crossed through the 200, USANA. It's an expensive stock. It's in the same family of Herbalife, 2 pocket pivots down. I might look for this one. This is on my short list, potentially either to break down at the open or trades back up to the 200 and drops. Certainly something that I might be looking at. ASML has gapped down below the 200. Also an expensive stock. Everything is red. WellCare Group. So these are stocks that meet some of their criteria. I wouldn't be shorting this one. It's in a nice uptrend. At least not shorting it yet. So any of the ones that I looked at that I thought were obvious. Here's one I don't get is Zillow. Why is this an $88 stock based on its revenue and its earnings? Obviously, it's got to be its space. Real estate information marketplace. Seems like a lot of money for a stock that doesn't make money. I think they've got some great relationships. That's probably the valuation play. This may be the short of the day. If anybody was lucky enough to short as it moved back up into its moving averages, Herbalife had some horrible news, FBI investigating. That never bodes well. The stock's going down further. So you can do some of the pre-planned, or you can come up with your favorite scans. And I'm going to go into Smart Groups, all securities, and if I want to look at stocks, leading stocks, I might look at Sprinters. Boy, this Chinese plastic company keeps coming up. I got to look at it. Well, you know, nice uptrend, forced kahunas, multiple pocket pivots, volumes. They go into my view because I like my view better, but that's just because that's the view I use. Nothing wrong with their view. And I see all green up at the high jump bar. That's a little bit worrisome. It's a cheap stock, doesn't make any money, and it's Chinese. Pilgrim's Pride is one of those chickens, and this is in our list that we picked up in March this year, running up at 17, still very bullish appearing, although it did have a PSAR flip. It's in a squeeze right now. A couple other things that I do. So I might look at the Sprinters list, which is what I have here. There are a number of trading systems built in. Go back up to Woodward and Brown. Force index scans. And these are looking for stocks in groups, stocks that are in groups to the upside and stocks to the upside. And these are some of those that are moving on the force. So we've looked at a lot of them already. Here's one of the ones I like, ETP. We mentioned it earlier as well. And Basing forever had a pocket pivot at Kahuna on Friday. Everything is green. So I'm looking at this as a sideways price power and a 6.7% dividend yield. I think this stock is going to run from here because of that dividend yield. So I'm just looking at 2DM up stock groups, finding stocks that have positive force in groups that have positive force. Many of these are the same stocks that we've looked at already. I want to look to the downside, stocks and groups with negative force. A couple things I also wanted to finish up with. I know I'm all over the place today, but the problem is there's just not anything from a top-down perspective to be buying. It's going to all be bottoms up. I hope you get the idea that there's just incredible power to this program. I move quickly, and you're probably lost. Come to Florida, enjoy the beach, and you'll go home knowing more than I know because we're going to all learn from people in the room. All right, here's an exercise for you. I said buy box stocks, so let's figure this one out. Let us go into all securities. And for my view, I'm going to start with my scorecard view, which is just has everything in there. All 7,971 stocks. Now, the first thing I want to do is I'm going to make a group from this, and we're going to put it in the user group, and we're going to call it is our HGS box fishing. So I have to make a decision now in this, no index. So now we're going to open up, it's going to say those stocks. Where do I want to limit the ERG into? So I'm going to go into my filters, and I'm going to make a new filter. May not be really new. All right, it's going to be in my user filters. New filter. And so I'm going to have to put some characteristics. I want last close to be above what? Your filter. All right, I heard you speak. Make it above $2. How about volume? I don't want Ghilardi buying the entire float in one day, so it's got to have some volume. How about the moving average of volume be greater than, I'm going to make it a little higher than normal, 250,000. So now my 7,971 stocks, oh, wrong one, Jeffrey. 28 moving average of volume. I'm now down to 2882. Then I want to get HGS ERG. Think about which one I want for this. I think I want, all right, HGS ERG, and I want this to be above 240. Now I'm down to 136 stocks. Hit OK. I'm going to have to call this something. ERG 240 filter the boxes. Hit OK. And now I want to make a group from list. And I want to call it ERG 240. So now I'm down to 135 stocks that met my criteria. Now this is where this program gets unbelievably cool. No index. Notice how many oil gas explorations. That's what's working right now. And I've already set it up for HGX boxes. And you could see that I've got 2 in box 9, I got 20 or so in box 7, I got 22 in box 1. And then you go into, see that little make groups from slice. And I want those groups to be in we're going to call it slices 4.13.2014 ERG 240 $2 and 250K. I'm going to hit my OK. This takes a couple seconds. There I got my boxes. Box 1, here's my FANG. Box 2, box 3, box 4, box 5, 6, 7, 8, and 9. If this market bottoms tomorrow, Tuesday or Wednesday, I'm sharpening my pencil and I'm going to start buying a bunch of the box stocks. There's plenty of good stocks in the market that you can look at. Historical, over every rebound, these are the stocks that are going to be leaders. And since I could buy out of 8,000 stocks or I could buy out of 100 stocks, I'd rather do my math and look at these charts. So that's one thing I use this for. The other thing I use this for is to populate a grid and look at the performance each day, look at for the new highs, because sometimes when these leaders start to break out, it gives you evidence that the market's going to turn around. So there you have how to make the boxes in HGSI. There is no easier way of doing it than I just showed you, folks. So I guess on that, you're getting tired of me and I'm getting tired of talking. Let me go back and make my selfless plea. Would love to have you all attend, or as many as possible, attend my upcoming seminar. If you like the stuff that I do here, I think there's a lot of reasons why you want to come, including it tells me that I should keep doing this. Again, I don't do any of this for the money. I do this because I like to teach, and it's a chance for me to give back because so many people gave so much to help me learn what I'm doing, or at least learn how, I don't know if I know what I'm doing, but help me make a lot of money. June 21st to 23rd, there's my contact information. Wouldn't you like to be looking out at this at night, this in the morning, and hanging out with 15 to 20 of your buddies and learning how to trade better? 21st, 23rd, Singer Island, Florida. You fly into Palm Beach. It's a 15, 20-minute cab ride. You fly into Lauderdale. You rent a car. We'll teach you to become your own guru. Again, here's the topics, some of the tools that we're going to use. Feed you all your meals except for Friday night and Sunday night. And we'll have a lot of fun drinking my wine at the cocktail party. I've got to clear out, get some new stock. $850 all-inclusive, $1,100 if you want my trade station indicators. I'll leave that up there and say goodnight. Be safe. Be wary of what this market's going to do, and be ready to ride some volatility because we're going to get some. That's that much you know for sure. Good night, everybody, and thanks again for all your support.